You know that feeling, right? That pit in your stomach, that fear of buying right at the very top, just seconds before the market decides to take a nosedive? Well, what if you could flip that script? What if you could turn that exact moment of fear into a systematic, high probability opportunity? Today, we're going to break down a really powerful system inspired by the work of veteran trader Oliver Velez that's designed to do just that. It's called the 85% edge strategy, and it all starts with a simple but profound change in how you look at the market. And this quote, this is everything. This is the key to the whole system. It's a total mindset shift. See, instead of gambling on that tiny 15% chance that the market's going to recover, this strategy says, wait a minute, what about the other 85%? It's all about finding that low odds bet and just playing the other side, putting the huge odds squarely in your corner. All right, so here's our game plan. First, we'll dig into the core logic of this 85% edge. Then we'll cover the 4 big signs that a market is topping out. After that, we're going to tackle the most critical question. Is this a healthy little dip or a total collapse? From there, we'll get into the nuts and bolts of the crash play itself. And finally, put it all together so you can see how to turn what looks like chaos into a clear opportunity. So first things first, what's the actual goal here? It's really a 2-part mission. Part 1 is to have a system for spotting when a market is getting exhausted and is probably near a peak. And part 2, once it does start to fall, is to have a crystal clear way of knowing if it's just a normal pullback, a buying opportunity, or if it's something way more dangerous. And listen, this isn't some black box algorithm or anything complicated. At its heart, this is all about reading human nature. It's about reading market psychology. Velez has been using these ideas for decades, and they work across all markets and timeframes. Why? Because they're based on the predictable ways people act, especially with fear and greed when their money's on the line. Okay, let's get into the good stuff. How do we actually see a top forming before it's yesterday's news? Well, this system lays out 4 specific clues that tend to show up together right at a market peak. Think of them like the market's tells in a poker game. These are the big 4 we're on the lookout for. First, a mature run-up that has 3 to 5 distinct legs. Second, that final leg goes almost straight up, nearly vertical. Third, we look for a massive bar he calls an exhaustion elephant bar. And fourth, something called the 3-finger spread. Now, you don't always need to see all 4, but Velez says he can count on one hand the number of major tops he's seen that didn't have at least 2 of these flashing red. So let's break down that first one. Markets don't move in a perfectly straight line, right? They move in waves or legs with little pauses in between. A healthy, mature trend usually has about 3 to 5 of these legs. The rule of thumb here is pretty simple. Legs 1 and 2 are where you want to be buying. Leg 3 is for riding the trend. But legs 4 and 5, that's profit-taking time. Buying that late in the game is just a high-risk, low-reward bet, because the move is pretty much on its last legs, literally. This one is such a powerful visual cue. You see this strong move up, and then bam! One last giant green candle that's bigger than all the rest. Now that might look like incredible strength, but it's the exact opposite. It's a sign of total exhaustion. It means the bulls have thrown every last dollar they have at it. They've emptied the clip. They've trapped all the late buyers at the very top, and now there's just no fuel left in the tank. And this one is brilliant. The 3-finger spread. Imagine your hand. Your top finger is the stock's price. Your middle finger is the 20-period moving average, and your bottom finger is the 200-period. When the price gets so far away from its averages that you can spread those fingers really wide apart, it's a huge red flag. It means the stock is on thin ice. Think about it. So many people are sitting on massive profits, and the second it shows any weakness, they're all going to rush for the exit at the same time. It's the perfect setup for an avalanche. Okay, so you've seen the signs. The market looks toppy and it starts to drop. This brings us to probably the single most important question any trader has to ask in that moment. Is this just a healthy little pullback I should be buying? Or is this the start of a catastrophic collapse? This system gives us a really clear way to figure that out. And this is the tool we use. It sounds kind of technical, but it is dead simple. You just take the entire run-up, from the very bottom to the very top, and you draw a few lines. You slice it in half, and then you mark the 1/3 and 2/3 levels. That's it. This creates 4 very distinct zones, and where the price pulls back to tells you everything you need to know about the odds moving forward. And just look at this. Look at how fast those odds change. If the price just dips into that top third zone, there's still an 80% chance it's going to make a new high. Pretty good. If it drops a little further into the top half, the odds go down to 65%. Still not bad. But the moment it slices through that halfway point, look out. The probability of seeing a new high just collapses. It plummets to a mere 15%. That's it. That's the statistical foundation for the entire 85% strategy. So now we can clearly define the two scenarios. On one hand, you have a healthy pullback, what Velez calls a dift. It's a gentle 45-degree drift that stays above that critical halfway mark. He says it looks like a hang glider just gracefully coming down for a landing. But on the other hand, you have a collapse, or a trap. This is a violent vertical drop that just knifes right through that halfway point. This is like someone tripping off the top of a mountain. One is a healthy rest, the other is a massive warning shot. So, you've identified a trap. You see that vertical drop, it's blown through the halfway mark, and you know the odds of a new high are now just 15%. Okay, now we get to the fun part, the actual actionable trade setup designed to profit from this exact situation. It's called the crash play. The trigger for this entire play is one specific signal, the crash bar. Now, this is not a normal red candle. This thing is violent. It's elongated. It's dramatically bigger than any of the bars that came before it. This isn't just regular folks selling. This is a telltale sign of big institutions dumping their positions. It's a fundamental power shift in the market, happening right before your eyes. And the execution from here is just pure mechanics. No guesswork. First, you spot that unmistakable crash bar. Next, just like we did with the whole run-up, you divide that single bar into halves and thirds. Then you wait. You're waiting for a weak, pathetic little bounce back up into the lower half of that bar. This is what he calls the sucker bounce. And your trigger to get in? It's a simple color change, when a tiny green bounce bar gets immediately wiped out by a red bar, confirming that the bounce has failed. So what's the psychology behind this? It's all about trapped traders. Think of all the people who bought near the top. They're underwater, they're panicked. Any tiny bounce they see is their one chance to get out and cut their losses. So they sell into that bounce, which adds a ton of downward pressure and pretty much guarantees that weak little rally is going to fail. It's a sucker play because it capitalizes on that predictable selling pressure from all the trapped longs. And this brings us full circle, right back to our magic number. Once you see that violent crash bar and you see that weak sucker bounce fail, the game has completely changed. The probability of the market making a new low is now 85%. You've done it. You've successfully taken a low probability, 15% chance of a new high, and you flipped it completely on its head to create a powerful, high probability trade to the downside. All right, so let's pull all these ideas together, because this isn't just a handful of random tricks. It's a complete, logical system for reading the story of the market, from that euphoric peak all the way down to the panicked collapse, and knowing exactly what your job is at every single stage. So here's the flow, nice and simple. First, you use the 4 characteristics to spot a potential top. Then, as it starts to drop, you analyze it to figure out if it's a gift or a trap. And if you see a trap unfolding, you know exactly what to do. You switch gears and look for the crash play to turn that chaos into an 85% probability trade. At the end of the day, the real power of this whole approach is its simplicity. It's not about complex indicators or fancy software. It's about cutting through all the noise and focusing on a few key, repeatable patterns that are baked into human psychology. It's not about predicting the future. It's about systematically putting the odds on your side. And that's really the big takeaway here. This whole framework gives you a new lens to look at the market with. So I'll leave you with this question. The next time you see a chart plunging deep into the red, are you going to see chaos and panic? Or are you going to calmly look for the structure and see the potential for a high probability opportunity?